Welcome back, everyone. Today we're taking a closer look at one of the most frequently discussed questions in the Iraqi Dinar community. Across online forums, social media platforms, video comments, and investor groups, people often ask the same question: how much Iraqi dinar would someone need if their financial goal were $1 million, $5 million, or even $10 million? It is a question that attracts enormous attention because it combines simple mathematics with a topic that has generated years of debate and speculation. Before we begin, it's important to establish exactly what today's discussion is and what it is not. This video is not making a prediction about the future value of the Iraqi dinar. It is not suggesting that any specific exchange rate will occur, nor is it claiming that an official currency revaluation has been announced or is imminent. Instead, today's discussion is an educational exercise designed to explain how exchange rate mathematics works. By examining several hypothetical exchange rate scenarios, we can better understand why different people arrive at dramatically different numbers when discussing potential future values. Exchange rates determine how much one currency is worth relative to another. When that exchange rate changes, the amount of currency needed to reach a particular dollar value also changes. That simple relationship is at the heart of today's discussion. Rather than focusing on rumors or speculation, we'll focus on arithmetic, economic context, and publicly available information about Iraq's exchange rate framework. One reason this topic creates so much confusion is that discussions online often mix together facts, opinions, assumptions, and rumors. Someone may claim that only a small amount of Iraqi dinar could someday be worth millions of dollars, while another person may insist that billions of dinars would be required. Without understanding the exchange rate each person is assuming, those statements can sound contradictory. In reality, they are often based on entirely different hypothetical exchange rate assumptions. Throughout today's analysis, we'll demonstrate how the required amount of Iraqi dinar changes under different hypothetical exchange rates. These are mathematical examples only. They are not forecasts, investment advice, or indications of what the future holds. Their purpose is simply to illustrate the relationship between an exchange rate and the amount of currency needed to reach a particular dollar value. For example, if someone assumes a very low hypothetical value for the dinar, reaching $1 million would require a much larger number of Iraqi dinars. On the other hand, if someone assumes a much higher hypothetical exchange rate, the number of dinars needed to reach the same dollar amount becomes significantly smaller. This is basic currency mathematics, and understanding that principle helps explain why discussions in the investment community can vary so widely. At the same time, it is essential to separate hypothetical calculations from official policy. Iraq currently maintains an official exchange rate framework administered by the Central Bank of Iraq. The official exchange rate is established through monetary policy and is distinct from the parallel market, where foreign currencies may trade at different prices due to supply, demand, liquidity, and other market factors. This difference between the official rate and the parallel market is an important part of understanding Iraq's current currency environment. The Central Bank of Iraq has consistently emphasized that its primary objective is maintaining monetary and financial stability. Officials have repeatedly stated that any decision regarding exchange rate policy would be communicated through official channels rather than through anonymous social media posts, online rumors, or unofficial documents. This point has been reiterated many times because misinformation about the dinar frequently circulates online, particularly when speculative claims begin attracting attention. That distinction is worth remembering throughout today's discussion. Hypothetical calculations can be useful educational tools because they demonstrate how exchange rates influence currency values. However, hypothetical examples should never be mistaken for evidence that a particular exchange rate has been approved or will occur in the future. Another source of confusion comes from the difference between an exchange rate adjustment and a currency redenomination. These are two separate concepts that are often discussed together even though they have different economic meanings. An exchange rate adjustment changes the value at which one currency trades against another. A redenomination, on the other hand, changes the face value of currency units without necessarily changing purchasing power. Because these terms are sometimes used interchangeably in online discussions, misunderstandings frequently arise. Today's video is designed to avoid that confusion by focusing only on clearly labeled hypothetical exchange rate scenarios. We'll examine how the numbers change under different assumptions while keeping those assumptions separate from current policy and official statements. It is also worth remembering that the value of any national currency depends on a wide range of economic factors. These include inflation, foreign exchange reserves, fiscal policy, government spending, economic growth, trade balances, oil revenues in Iraq's case, banking sector development, investor confidence, and broader global economic conditions. Currency values are not determined by a single event or a single announcement. They reflect the interaction of many economic variables over time. For Iraq, oil remains one of the most significant drivers of government revenue and foreign currency earnings. Fluctuations in global energy markets can therefore influence the country's fiscal position and broader economic outlook. Banking reforms, modernization of payment systems, anti-money laundering measures, and efforts to strengthen financial institutions are also closely watched by analysts because they contribute to the long-term stability of the financial system. These broader economic developments often receive less attention than dramatic social media headlines, yet they are the factors that economists and financial institutions generally examine when assessing a country's monetary environment. While rumors may generate excitement, sustainable currency policy is typically shaped by economic fundamentals rather than speculation. As we continue through today's discussion, our goal is to replace confusion with clarity. Instead of relying on headlines or viral posts, we'll use straightforward mathematics and publicly available information to understand how exchange rates affect currency values. By doing so, viewers can better interpret the wide range of claims they encounter online and distinguish between hypothetical examples and confirmed policy decisions. Whether your interest in the Iraqi dinar comes from curiosity, academic study, or following developments in Iraq's economy, understanding the mathematics behind exchange rates provides valuable context. It allows discussions to be grounded in arithmetic and economics rather than assumptions alone. So, let's begin our analysis by examining several hypothetical exchange rate scenarios. As we go through each example, remember that the purpose is educational. None of these scenarios should be interpreted as forecasts or official guidance. They simply demonstrate how changing the assumed exchange rate changes the amount of Iraqi dinar that would mathematically correspond to $1 million, $5 million, or $10 million. With that foundation established, we can now move into the calculations and explore why the answers differ so dramatically depending on the exchange rate being assumed.